Imagine waking up tomorrow to a world where every major bank is frozen ATMs. Display service unavailable markets halt in panic. Governments scramble behind closed doors, and ordinary people like us discovered that the global financial system was being held together by a $900 trillion invisible monster no one ever understood. It's called the global derivatives market, a complex, unregulated financial web so enormous that it's 10 larger than the entire global GDP. Before we dive into the explosion, we need to understand the birth of the monster. Derivatives started as a brilliant, shimpery invention. A farmer wanted protection from falling crop prices. A buyer wanted protection from rising prices. They agreed on a future price, a derivative contract. This idea spread. Oil traders used it. Currency dealers used it. Then interest rate swaps. Then credit default swaps. Each new version added more complexity, more layers, more ways to gamble. But here's what almost no one knew. Behind the scenes, a secret race had begun. Banks realized that derivatives could be used not just for safety, but for leverage, the financial equivalent of steroids. With leverage, $1 could control 10. 10 could control 100. Risk multiplied silently and profits skyrocketed until one day the financial world became addicted. Big banks, hedge funds, Wall Street giants, they were all hooked. And instead of reducing risk, derivatives became the tool that amplified it. But the real twist? Derivatives were never fully regulated. Not in the 1980s. Not in the 1990s. Not even after the 2008 crash. A system this massive, this dangerous, was allowed to grow in the shadows untouched. Why? Because it made the right people rich, and the cost of failure would be paid by everyone except them. Origins of the bubble from simple hedges to global weapons. The derivatives market exploded for 3 key reasons. 1. Deregulation. 1999. In the late 90s, Congress passed the Commodity Futures Modernization Act. It essentially said, derivatives, don't worry, they don't need oversight. This unlocked a gold rush. Banks created exotic contracts no regulator could track. Credit default swaps reached into trillions overnight, and complex algorithms replaced common sense. 2. Easy money. Early 2000s, with interest rates low, Wall Street needed new, high-return products. Derivatives became the perfect drug. Mortgage-backed securities, synthetic CDOs, interest rate swaps, each one hiding layers of risk, each one stamped AAA by credit trading agencies, until the entire system was floating on air. 3. Global interconnection. The world became financially wired together. A bank in Switzerland could bet on mortgages in Florida. A hedge fund in London could bet on oil prices in Saudi Arabia. Everyone was exposed to everyone else. The derivative monster had grown global. The rise, how the $900 trillion bubble formed by the early 2000s. Derivatives began multiplying exponentially. Step 1. Banks created products no one understood. Wall Street developed contracts with thousands of variables. Only their in-house teams could decode them. This created an information imbalance. Customers couldn't understand. Regulators couldn't understand. Even CEOs claimed they didn't understand. But they all agreed on one thing. The profits were too good to stop. Step 2. Governments loved the illusion derivatives, made economies look stable. They reduced the appearance of risk. This allowed more borrowing, more spending, more growth, even when the foundation was rotten. Step 3. The bubble fed on itself. Each new layer of derivatives required more derivatives to hedge risk. It was like building a skyscraper on top of another skyscraper, on top of a house of cards. This is how $20 trillion became $50 trillion, then $200 trillion, then $900 trillion. But here's where the mystery deepens. Derivatives don't need to collapse all at once. Sometimes just one small event, a single bankruptcy, a sudden rate change, a political shock can trigger a chain reaction. Exactly what happened in 2008. Breaking point. The first time the monster nearly destroyed the world, think back to 2008. People think the crisis happened because of bad mortgages. Yes, but that's not the real reason. The crisis happened because banks used derivatives to multiply that risk 100 times. When mortgages defaulted, the derivatives tied to them exploded. The system came to the edge of collapse. And then the world learned something terrifying. Almost no one knew where the risks were. Banks didn't know. Governments didn't know. Even the Federal Reserve didn't know. Every institution was tied to every other institution. It was a web. And if one major bank fell, they all would. This is why governments bailed out banks. It wasn't to save bankers. It was to save the entire global derivative network. The monster survived. But instead of killing it, the world let it grow bigger. And today, it's 5 larger. The fallout, the monster that never died, the aftermath of 2008, created a new reality. 1. Banks became too big to fail when governments saved the banks. Banks realized something crucial. We can take bigger risks. If we fail, taxpayers will rescue us. This created moral hazard, the gasoline that fuels bubbles. 2. Derivatives became more hidden after 2008. Instead of reducing risk, Wall Street simply moved derivatives off the books. They flowed into unregulated shadow banking, networks, private funds, offshore accounts, global institutions, with no transparency. 3. Interest rates stayed artificially low for over a decade. Central banks kept interest rates near zero. This created cheap money. Cheap money created more derivatives, and more derivatives created even more interconnected risks. And now, interest rates are rising fast, which brings us to the real danger. Why the bubble is about to burst? The perfect storm has arrived. 3 major pressure points are now threatening the $900 trillion derivative web. Pressure point 1. Rising interest rates. Many derivatives depend on predictable interest rates. When rates were low, everything seemed stable. But now, global rates have risen at the fastest pace in modern history. This means derivative contracts tied to rates are breaking hedge. Positions are failing. Banks are being hit with unexpected losses. Margin calls are skyrocketing. This is exactly what broke Silicon Valley Bank in 2023. Interest rate risk, derivative losses, collapse. That was just one bank. Imagine this happening across the system. Pressure point 2. Currency wars. Derivatives tied to foreign exchange markets make up tens of trillions. With global inflation, wars, and political instability, currencies are swinging wildly. Each swing creates winners and losers, but if the losers can't pay, a domino effect begins. Pressure point 3. Shadow banking explosion. Over $200 trillion in derivatives now sit outside traditional banks. No regulation. No reporting. No safety nets. If one shadow institution collapses, it can trigger losses across multiple continents within hours. This system is built for speed, but not for safety. Failed fixes why regulators still don't understand the monster after 2008. Governments promised reform, but almost every fix failed. 1. Better reporting. Banks simply changed how they report risk. The contracts are still there, just harder to see. 2. Stress tests. Stress tests assume predictable behavior. Derivatives are not predictable. 3. Capital requirements. Banks found loopholes. Shadow institutions don't follow the rules anyway. 4. Derivative clearinghouses. These were meant to track and settle derivative contracts. But guess what? Clearinghouses themselves are now systemically important. If they fail, the entire system collapses faster. Imagine solving a fire hazard by storing all the gasoline in one room. That's the clearinghouse problem. Modern perils. The patterns keep repeating. History is repeating itself. Right now. 1998, long-term capital management, LTCMA hedge fund, used derivatives to make huge bets. One shock event collapsed their positions. The Fed had to rescue them. 2008, AIG. They sold so many credit default swaps that when mortgages fell, AIG collapsed instantly. Another government rescue? 2023 SVB プラス Credit Suisse rate derivatives and interest mismatches destroyed both banks. 2024 to 2025 hidden losses, emerging banks worldwide quietly report unrealized losses. This is usually code for we are bleeding through our derivative positions. The same pattern repeats. Growth, risk, overconfidence, shock event, collapse, bailouts, repeat cycle, the difference today. The bubble is 10 bigger. The future. What happens if IT bursts? Scenario 1. A major bank fails. The fall of one too big to fail. Bank could freeze global markets within 24 hours. Scenario 2. Clearinghouse failure. If a clearinghouse collapses, trillions in contracts become worthless. No one knows who owes what. Scenario 3. Global liquidity crisis. Banks stop trusting each other. Credit markets shut down. Governments print money to stabilize the system. Inflation surges. Scenario 4. Derivative chain reaction. One failed contract triggers a second, then a third, then thousands. This is how a contained event becomes global. The real reason nitrogen monoxide 1 talks about this. 2 reasons. 1. The system is too complex to explain quickly. Most people think the topic is boring. Banks benefit from this. 2. The monster can't be removed without crashing everything. Derivatives now support. Interest rates, mortgages, pensions, currencies, government debt, corporate loans, bank stability. Removing derivatives is like pulling the thread, holding the global economy together. This is why the topic is buried. Not because it's secret, but because the truth is too inconvenient. If you learned something new today, if this opened your eyes to how the financial world really works, hit the like button, subscribe, and share this video with someone who still thinks the global economy is stable.